In this video, I'll demonstrate the accounting and presentation of customer deposit liabilities using textbook question 13.4, which relates to learning objectives 3 and 9. So in this example, Diagnostics Corp follows IFRS and sells its products in expensive reusable containers. The customer is charged a deposit for each container that's delivered, and it receives a refund for each container that's returned within 2 years after the year of delivery. When a container is not returned within the time limit, Diagnostics accounts for the container as being sold at the deposit amount and credits an account called container sales revenue. Here's some information for 2020. Containers that are held by customers at the end of December 31st, 2019 from deliveries in both 2018 and 2019 total 650,000. This actually represents the opening refund liability balance. Then, during 2020, 894,000 in containers are delivered, and also during 2020, $115,000 in containers are returned from 2018, 280,000 from 2019 deliveries, and 310,400 from 2020 deliveries, for a total of 705,400 in returned containers. Our first requirement is to prepare all the journal entries for Diagnostics for the returnable deposits during 2020, and we're going to use a refund liability account. The second requirement is to determine the total amount that the company should report as a liability for returnable deposits at December 31st, 2020. The first journal entry is a simple one, where the company will record the cash that it will receive for deposits and record the refund liability of $894,000 on containers delivered in 2020. The second entry will record the refund of deposits for containers returned during the year of $705,400. So there's a debit to the refund liability account and a credit to cash for each of the 2018, 19, and 2020 returns. The last entry is to record the revenue associated with the expired 2018 containers that have not been returned. So we will debit the refund liability and then credit container sales revenue both for $55,000 that's calculated as the beginning $170,000 refund liability balance minus the $115,000 refunded during the year. For our second requirement, to determine the total refund liability at the end of 2020, the easiest way to do that is just to use a T account and start with the beginning liability balance of $650,000. Add in the 2020 deliveries of $894,000, subtract the returns of $705,400 during the year from deliveries in all years 2018 through 2020, and then subtract the expired 2018 deposits of $55,000, resulting in an ending liability of $783,600. Requirement C asks us to determine how the liability should be reported, i.e., current or long-term. Well, if we assume an operating cycle of 1 year, which is common for most businesses, then the refund liability would be split into two components. The current liability would be comprised of the remaining 2019 deposits that have yet to be returned or expired, made up of the $480,000 beginning balance from 2019 minus the returned containers of $280,000, resulting in $200,000. The remaining portion would be the 2020 deliveries less the 2020 returns, so $894,000 minus $310,400 is a total long-term portion of $583,600. Notice that both of those added together work out to be the $783,600 total refund liability. The last requirement D asks us if Diagnostics had followed ASPE instead of IFRS, would any of the answers to our first three requirements be any different? And the answer is no. This is one of the areas where the treatment for customer deposits is identical under ASPE and IFRS.